The essence of IAS 16 Property, Plant and Equipment. PPE are tangible assets which are held by the entity for use in production or supply of goods or services, for rental to others, or for administrative purposes, and expected to be used during more than one period. There are two recognition criteria. The first, it is probable that future economic benefits associated with the item will flow to the entity. And the second, the cost of the item can be measured reliably. These two criteria apply both to subsequent expenditure and costs incurred initially. Well, there is additional guidance as well. The smaller items such as tools may be classified as consumables, and these are expensed rather than capitalized. Where they are capitalized, they are usually aggregated and treated as one. Further, large and complex assets should be broken down into composite parts and each depreciated separately if the parts have differing pattern of benefits and the cost of each is significant. Initial measurement. PPE should be initially measured at cost. That includes purchase price less trade discounts and rebates, directly attributable costs of bringing the asset to working condition for intended use. These may include site preparation, initial delivery and handling costs, installation costs, assembly costs, professional fees, costs of testing. Finance costs can also be capitalized for qualifying assets. We will see this in next video, alright? So, coming to subsequent measurement, we can choose any of the model, either the cost model or revaluation model. In cost model, we have to carry the asset at cost less depreciation and any accumulated impairment losses. Under revaluation model, we have to carry the asset at revalued amount, that is the fair value less subsequent accumulated depreciation less accumulated impairment losses. The revaluations must be carried out regularly depending on volatility. The asset should be revalued to fair value using fair value hierarchy in IFRS 13. If one asset is revalued, so must be the whole of the rest of the class of assets at the same time. Any increase in value is credited to OCI, which is other comprehensive income, and the revaluation surplus in equity. A decrease is an expense in P&L after cancelling a previous revaluation surplus. Coming to depreciation, depreciation is based on carrying amount in statement of financial position. It must be determined separately for each significant part of an item. The residual value and useful life of an asset as well as depreciation method must be reviewed each financial year end. Changes are treated as changes in accounting estimates and accounted for prospectively as adjustments to future depreciation. Another thing to note is depreciation of an item does not cease when it becomes temporarily idle or is retired from active use and held for disposal, unless it is classified as held for sale under IFRS 5. An item of PPE should be derecognized on disposal of the item or when no future economic benefits are expected from its use or disposal. Any profit or loss on disposal is calculated as net proceeds less carrying amount in the SOFP. Further, when a revalued asset is disposed of, any revaluation surplus is transferred to retained earnings. There is further guidance on exchanges of assets. Exchanges of items of PPE, regardless of whether the assets are similar, are measured at fair value. Unless the exchange transaction lacks commercial substance, or the fair value of neither of the assets exchanged can be measured reliably. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up.